Okay, let's talk about Tesla's latest earnings report because it has created this fascinating almost split screen moment. On one side, you've got the promise of an almost sci-fi future that's all driven by artificial intelligence. But then on the other, you have the stark, kind of challenging reality of what it is today, a car company. So this explainer is going to get right to the heart of that contradiction. I mean, how can a company be launching literally world-changing technology? We're talking robot taxis, humanoid robots, and at the same time, its stock price is taking a serious hit? It's a puzzle that has investors and really the public scratching their heads. And here it is, that contradiction laid out plain as day. The headlines, they're filled with just incredible progress. Paying customers are actually riding in driverless cars in Austin right now. And the Optimus robot, it's getting closer and closer to production. But at the same time, the market is reacting to a tumbling stock and a warning from the CEO himself that there could be some difficult times ahead. So let's start with the most obvious piece of this puzzle, right? The numbers. The numbers from the core car business, they just weren't great. And look, this is the foundation that everything else is built on. And in the second quarter, that foundation started showing some real cracks. The first major crack? Total revenue. It dropped 12% compared to last year. That's a drop to $22.5 billion, which also missed what Wall Street was expecting. It's simple, really. Fewer dollars are coming in the door. And, that drop in revenue, it hit the bottom line directly. We're talking net income, the actual profit after all the bills are paid. That fell 16%, down to $1.2 billion. And this wasn't just a one-off thing. It was the third quarter in a row that profits have gone down. So what's behind all this? Well, a huge part of it is this number right here, which is a super crucial metric for any car maker. Tesla delivered just over 384,000 cars. That's a drop of almost 14%. And the decline was especially sharp for its more expensive, higher-margin models. Their sales fell by more than half. And look, this wasn't just some analysts being pessimistic. The CEO himself didn't sugarcoat it. During the earnings call, Elon Musk told investors pretty bluntly, quote, "We could have a few rough quarters." And he pointed to things like EV tax credits that are expiring and high interest rates, which just make it harder for people to afford new cars. But the story gets even more complicated when you start to dig into how Tesla actually calculates its profitability. It's not just about the numbers themselves, but about what actually goes into those numbers. And this question, man, it opens up a really fiery debate that you see raging in investor communities online. It kind of challenges one of Tesla's biggest claims to fame, its supposedly industry-leading profit margins. So on paper, Tesla is always reporting these very high automotive gross margins. But here's the catch that critics love to point out. This figure might not be an apples-to-apples comparison. They argue that Tesla leaves out major costs like R&D from this specific calculation, while the traditional car companies include them. Yeah, it's a pretty nerdy accounting debate, but the result is that Tesla can end up looking a lot more profitable than its rivals, even if the underlying business realities are maybe a little bit closer. All right, so if the car business is struggling and its profitability is maybe being debated, why are some investors still so optimistic? Well, it all comes down to the company's massive, absolutely defining bet on artificial intelligence. First up, the Robotaxi. And this is no longer just a concept on some slide deck. Nope, the service is live with paying customers in Austin. It's already logged over 7,000 miles without any major safety issues. And the plan to expand is, well, it's incredibly aggressive. The goal is to reach half the U.S. population by the end of this year. Now, that's pending, of course, a whole lot of regulatory green light. Then there's the second part of this big AI bet, the Optimus humanoid robot. The timeline here is just as ambitious. Tesla expects prototypes of the final design by the end of this year. They plan to start mass production in early 2026, and they have this truly aspirational goal of building 1 million of these things a year by 2031. Wow. But there's another piece to this puzzle, and it's one that often gets completely overlooked in all the headlines about cars and robots. It's a part of the business that's quietly become an absolute powerhouse. Believe it or not, Tesla's energy division has actually become its most profitable business. Just look at this. In the first half of 2025, it generated an incredible 23% of the company's total profit, while only making up 13% of its revenue. I mean, that means its profit margins are now over 30%. And this isn't some tiny little side business either. The division, which sells these huge, large-scale batteries like the Megapack, is growing incredibly fast. Deployments are up 48% in just the first half of the year. This provides a really powerful and highly profitable backbone to the company. It's basically helping to fund its more ambitious and, let's be honest, for now, less profitable ventures. Okay, so let's pull all these different threads together. When you do that, you're left with two very, very different stories about the exact same company, existing at the exact same time. It's wild. In one corner, you've got Tesla, the car company. It's facing some serious headwinds, right? Declining revenue, more competition, expiring tax credits. But in the other corner, you have Tesla, the AI and energy company, a pioneer whose biggest projects, Robotaxi, Optimus, and that super profitable energy division are really just getting started. So, which one is it? Is Tesla a car company that's hitting a wall? Or is it an AI and energy company that's sitting on the launching pad? The answer? Well, it probably depends on just one thing. Can its massive bets on the future scale fast enough to overcome the very real challenges of today? And at the end of the day, that leaves every single investor, and every one of us, to decide which Tesla we truly believe in.